people joining. Welcome to the ML&R client training update. We're really happy to have you. We're sorry we had to do it virtually again. We had really hoped to see all of you this fall, but one more time. So thanks for joining. We're gonna start with our fall tax update, and it will go until 9:30, and we'll have a 10-minute break before we join into the next training. And we will email the CPE certificates out after all of the sessions are done. You don't have to join all of the sessions. You can still get credit for one at a time. We will also email the slides out after this. And I will pass it off to our tax group, who is going to be talking first. So Anna Steppen, Blaine Martin, and Jennifer Krupa. And I'll let y'all take it away.
Hi, good morning. I'm Anna Steppen. I'm a tax partner at Maxwell Lock & Ritter. I've been lucky enough to be part of this team here since 2007 after starting my career at Ernst & Young. And my work focuses on tax compliance and consulting for non-public businesses and their owners. I spend a little over half my time every year with our real estate clients, and then I work with other sorts of businesses, retail, wholesale, technology, professional services. I see a lot of multi-state issues, a lot of business asset sale issues, and then also some foreign sub and foreign parent type issues. So lucky for me and for you, I have a couple of my colleagues joining today, and I'll let them introduce themselves.
Thanks, Anna. I'm Jennifer Krupa, and I've been with ML&R for a little over 10 years. Before coming to ML&R, I was in the state and local tax group at PwC. At ML&R, I focus mainly on state and local income tax compliance and consulting issues, and I tend to spend most of my time looking at state nexus issues, state compliance complexities, especially for our pass-through entities, and also those state implications of large gain transactions.
And I'm the newbie of the group. I'm Blaine Martin. I've been with ML&R for 3.5 years now. I've been in public accounting for 11 total. I primarily focus on pass-through entities and their owners, specifically in the real estate industry is where I spend the majority of my time, but do have a handful of other manufacturer, wholesale clients that I deal with, and then deal with their individual tax issues as well. I'm excited to be with you guys today, and I'm going to turn it back over to Anna to give you our first little update.
Okay, thanks, Blaine. So this is our discussion agenda today. Nice, light little agenda we'll try to get through. I want to just say that, our goal here is to cover the things that we find to be most relevant to our business clients and the Austin business community. There's a lot going on in the tax world, and we can't cover all of it today. And specifically, I'll call out estate planning, as well as international tax matters that are just sort of off the agenda for today. Those are pretty specific and complicated and really would take their own hour to cover. So that said, those are very important, and if those are things that are important to you, please do get in touch with us and we can connect you with someone to talk about it. We're just not gonna go into them today. And we may pause briefly for a couple questions during the session, depending on what Sarah sees coming in through the Q&A, but we'll also have a Q&A at the end. So just wanted to let you know that before we dive in. So let's jump in. First thing, we're going to talk a little bit about federal tax legislative process and where we stand. I was preparing for this webinar and I was thinking about the last time we did the tax CPE for clients. That was last November. And so that was in this very politically fraught time. And I had to say, I don't know what's happening with taxes. And so we're here now, it's 10 months later, and it's a very politically fraught time, and I don't know what's going to happen with taxes. So feeling like we might not have come so far, but we will do our best. So where do we stand today? And I need to just caveat, this is not a training on the legislative process. I am not qualified for that. But I do know that we have two very large pieces of legislation in the works right now. We have the infrastructure bill, and then we have budget reconciliation. And the infrastructure bill has bipartisan support. It already passed in the Senate in August. And then on the other hand, the budget reconciliation is expected to be totally party line with no Republican support. So kind of the latest big step was that the budget resolution passed in both houses in August. And And what that does is clear the way for them to move forward with budget reconciliation, which means that they can pass a huge bill as long as it's all affecting, you know, taxes and revenue without any Republican support. So, you know, that's the path that we're on right now. The House said that they would vote on the infrastructure bill by the 27th of September, and they're, at least some of them are really trying to work the budget reconciliation hand in hand with that. So this is all, you know, pretty near term potentially. So these 2 weeks for them are supposed to be committee work weeks. And, you know, I know we tax accountants right now, we're in our fall busy season, but I am guessing that our busy season does not at all stack up to what those guys are dealing with right now in the committees. It's going to be a really busy time. The House and Senate leaders both said that they were aiming for the end of September to have the bills complete. You know, I don't know. I think that seems like a pretty aggressive, goal, but we will see. So what kind of things are we talking about? You know, we've had tax policy discussions for the last year, more than a year, through the campaign, and, you know, lots of talking points that weren't necessarily super detailed. But then at the end of May, the president did release a budget blueprint. That was May 28th. And so that sort of laid out the administration's tax goals in a more specific way. You know, it's important for us to remember that the president can say a thing, but that's not binding because it's Congress that drafts the legislation. You know, but it gives us an idea of which, you know, what way they're going and what is the administration and what do the Democrats kind of lean on taxes. So, so we're going to start with recapping kind of the key points that were in the president's blueprint, and then we can get into a little bit more of, you know, what do we think might really happen. And I don't want to ignore the fact that both of these bills have a lot of policy stuff in them, and we're going to kind of mostly ignore that stuff today because this is a tax session. So we're going to focus on the tax items, but understand that the tax piece is to fund the policy goals. So, and this is going to be very much, you know, a high level skim, but if anyone is interested or needs some late night sleep reading, you can go see the green book. The so-called green book is kind of where they write out all the explanations, and I've got the URL for that at the bottom of the slide, just in case you're interested. So, so starting with the business and corporate side, you know, the big highlight is increasing the corporate tax rate. That was 35%, dropped to 21% with TCJA a few years ago. And so, you know, in the president's proposal, that would sort of meet in the middle at 28%. There's also a 15% minimum tax proposal on worldwide book income, but only for corporations with income exceeding 2 billion. So I am fairly sure that that does not capture any of our Central Texas clients. The business side also included a whole host, which we won't get into, of changes to tax rates and rules on international business. And the big picture there is, you know, one, to raise taxes on the large multinationals, and then also to incentivize onshoring and disincentivize offshoring. There's also, you know, incentives for clean energy and reduced preferences for the fossil fuels, and likewise kind of a whole variety of incentives for housing, specifically low-income housing and energy efficient housing. So you can see where the tax kind of ties to the policy goals. And then on the individual and pass-through side, quite a lot. So we'll try to hit the high points. The proposal includes increasing the top marginal rate on individuals from 37 back to 39.6. So that's where it was before the TCJA. And just for sort of frame of reference, that would apply to married filing jointly kind of just over $500,000 of income in 2022 and be indexed for inflation. Also a big one is proposal to remove the preferred rate on capital gain for high income taxpayers. That one is pegged at, you know, AGI exceeding $1 million. So in the proposal, if you had income over $1 million, then your capital gains would be taxed like your ordinary. So that's a biggie for a lot of people for sure. Also, this is like been on repeat for years and years and years, but a proposal to take away the carried interest preference. So we call, that's in the news a lot, but that's profits, interest, or promote. There's a lot of different words for that, but, you know, it's income earned by service partners for the work that they're doing in investment partnerships. And so he does include a proposal to take away that benefit and tax it as ordinary. Not going to dive into estate and gift, but certainly should mention, that there are provisions in there to add a current tax event to some wealth transfers that currently are untaxed via, gift or death. And also eliminating the like-kind exchange, very popular with the real estate industry, the 1031 exchange. That's widely used, but the proposal is to take that away for gains in excess of, like you can see, $500,000 or $1 million for married filing jointly. So that one's a big target for the real estate lobby to keep. And a couple more. We have TCJ put in a limitation on excess business losses. So kind of entrepreneurs that are funding startups losing money, they put a cap on the amount of those losses you could use. That was set to expire in 2026, but there's a proposal to make it permanent. Also a proposal to sort of broaden the applicability of the self-employment tax and net investment income tax to all pass-through business income. So currently there's sort of a pretty big chunk of pass-through businesses. If you're, somewhat actively involved in an active business, an LLC, you're not paying self-employment tax on a big chunk of that, and probably not net investment income tax either. So there's a proposal to say, you got to pay one or the other on all of that. For high income taxpayers, I think, again, they use the $400,000 limit. Also proposing to increase funding for IRS enforcement. So that's a favorite of ours. Notably, at least in the President's Blueprint, no mention of changing the pass-through business deduction that has been complicated, but quite beneficial to a lot of our clients. And then, I'm staying out of the policy stuff for the most part, but since these are tax related, just want to mention, there was a lot of expanded benefits for lower income taxpayers these past couple of years during COVID. Earned income tax credit, child tax credit, those sort of things are all currently just temporary expansions, but the proposal would either extend or make those permanent. So that was what was in the President's Blueprint, but we said he doesn't get to necessarily decide. And so now Congress is working on these things. And so, in things that they do, and things they talk about, we get a little bit of signaling, I guess, in terms of where they're headed. And so when the Senate did their budget resolution vote, they have this thing, I saw it referred to as a vote-a-rama, and people get to kind of throw out all these ideas and people can vote, and it's totally non-binding, but it kind of helps understand where people stand on things. And so in that, some of the things that came out were that the Senate supports adding carve-outs. So if we eliminated the basis step up when people die and transfer assets, that would be huge. In the estate tax world, they've definitely indicated they'd support exclusions from those rules for family-owned businesses and small farms. There's some support for increasing the SALT cap, so that's that $10,000 limit on state taxes that you can deduct on your itemized. So that's been very unpopular, I would say, on the coasts where the income taxes are high, not as much of a deal here. But we could see that increase a bit. Senate also is looking like they're going to support keeping status quo on the 1031 exchanges, so we may get to keep those. And then very strong support, for preventing tax increases on people making less than $400,000. And they also signaled an interest in expanding the R&D, the research and development tax credit, and also preserving full expensing of research expenditures. So Blaine's going to talk about that a little bit more, but that's a thing that we've been really watching because it's a coming change. And so it's possible that we'll see through legislation that we get to kind of keep on doing what we've been doing. And on the House side, a couple other points. Big picture, sort of general support for the President's tax agenda, but maybe some modifications. Again, that $400,000 limit. So that's really been a theme for a long time, throughout the campaign and all up to now, that they don't want to raise taxes on people earning less than $400,000. So I'd be very surprised if that changed. House has indicated a hesitance to increase the corporate rate quite all the way to 28%, so maybe more like 25%. And then also hesitation about some of those other big items, the step up in basis and the raising the capital gain rate. So, and then there's, there's always a discussion. We talk about 3.5 trillion in terms of the spending, but there are a lot of offsets. And so, will it be fully offset, or will it, just have the about $1.7 trillion increase? That's a big number. So those are some of the things that have kind of been heard from the House and the Senate, which I think is informative for us. And then this last one, I'm going to call it news from a friend of a friend. So please note, not to be relied upon. These are kind of rumors from DC last week. So just for your information, but I won't be held to it. So the corporate tax rate increased maybe to 25%, seeing the top marginal rate increase to 39.6%. Again, that's where it was pre-TCJA. And then an increase to the top rate for capital gains, but probably not all the way up to ordinary, maybe in the 25% range. So, those top three are the big ones. And I would say those drive with, what I read in the newspaper this morning. So there seems to be some common agreement on those. Some other things that were likely were kind of addressing the SALT cap, and then, some movement on estate and gift. And interestingly, possibly some change on the 199A, that's the pass-through deduction, but not sure what that would mean. And then kind of on the less likely to happen, repealing that step up in basis at death, the 1031, the carried interest, and then that more broad coverage on net investment income tax and self-employment tax. Those were said to be less likely to happen. So, again, we don't know yet. I think that most people who are watching this do expect increases. Certainly not everything in the president's agenda, but some meaningful increases. The Democrats don't have really any votes to spare, so that gives the moderates a lot of power. So, I think the more extreme or progressive or bigger, however you want to call it, but the bigger tax increases, probably not as likely to make it through. But I do think that some things will happen, and you can see that, looking at the list. You can also see the impact of lobbying, like Real Estate Roundtable, for example. When we see 1031 and carried interest, things like that down in the less likely to happen, there's definitely some industry interest making their voices heard. And then, and some things pull better, right? Like taking the corporate rate to 25% doesn't tend to get the entire country riled up. So I was a little surprised to see the pass-through deduction on the list of things that may change, since that wasn't in the president's blueprint. And it's also structured to incentivize payroll and creation of tangible assets, but we will see where that goes. So I mentioned this at the beginning and don't want to take a deep dive, but just a couple quick comments. So the infrastructure bill has bipartisan support. It's really not a tax bill, but there are a few very targeted incentives, and then there are a few, a few tax offsets included. One is just enhanced reporting on cryptocurrency. So that's becoming bigger and bigger all the time, and I think the IRS feels like they're losing out on a lot of taxes there. Reinstating some Superfund excise taxes, so just some specific taxes related to pollution, expected to raise about $14 billion. And then interestingly, also mentioned termination of the employee retention tax credit. So that's currently scheduled to go all the way through the end of 2021. But in this bill, it was proposed that they might cut it off after Q3. So, and that, per these reports, would save the country $8 billion. So we'll see, and Blaine will talk a little bit more about that later. So, with that, here we are. Like, it's a tricky political time. We don't know exactly what's going to happen. So what do we do? What are we thinking about? What are we talking about right now? It's a little different from the normal, you're in planning things, bunching your charitable donations or placing business assets in service before year end, fund your retirement plan. Those are all good things, right? Those are all generally good advice. But right now we're talking about, when we look at near-term tax legislation. So the usual tax advice says, accelerate your deductions and delay your income, right? Pay taxes later. But, when we're facing potential tax increases, that advice kind of flips. I don't ever think it's a good idea to kind of let the tax tail, if you will, wag the whole dog. So transactions still need to make sense from a business perspective. But this is a time where you might consider, if you've got a deal that's coming through soon, to get income and gains recognized sooner than later while you kind of still know what the tax rules are and before an increase. I think the expectation is that most of the changes would go into effect in 2022 so that we would have the rest of 2021 to get some things done, but there is the potential for some things to be retroactive, and specifically possibly the increase on capital gain rate. So there was talk, that could be effective back to May 28th when the president's budget proposal came out. It could potentially be tied to when legislation passes this fall. So, we don't know, and you can't change the past, but I would say if you've got a deal in the works, you might just keep that moving to close quickly so you have, a little bit more, before something changes that might hurt your tax situation. So also when you're selling a capital asset, something that can be really useful for planning is installment sales. So you sell the asset, you have an installment note, that gives you the option to elect to use installment treatment, which, that kind of, it spreads your tax out over time as you receive payments. Or you can elect out of that and just recognize the whole gain at the time the transaction happens. And so that's a nice little planning tool. For example, you could close a deal now on a capital asset, and you could wait until you file your tax return next year to decide, do you want it to be a 2021 thing, or do you want to spread it out over time? So that's a nice tool to remember. I think it's important, if we're talking about capital gains going 20% to maybe 40%, that's a huge difference. And that's where you might feel fairly sure that you want to recognize it soon. If we're talking about a smaller difference, if we're talking 5% or 4%, I think then you really do need to look at time value of money and say, do I really want to pay all the tax sooner and save a few percent on tax versus keeping the money in my pocket later? So just, you have to look at the whole picture. And so some of the things that are in the proposals are kind of taking away some tax goodies, if you will, right? The low capital gain rate, the 1031 exchange. If those were to go away, that would be painful to many, but we still do have some nice benefits. So one thing, if we lose 1031 exchanges, we still have the opportunity zone benefits. There has not been talk of taking that away. So you could still defer gain into an opportunity zone investment. There has also not been talk about getting rid of the Section 1202 benefits. So that's kind of a big topic, but to really high level it, that's incentives for investors in early stage small corporations, and it can allow a gain exclusion up to $10 million if you meet the 5-year hold and a whole bunch of other requirements. So that's still a really nice benefit for investors in early stage. And then again, not an estate planning session, but please, for high wealth individuals and for families, please do make sure that you're talking to your estate planning team to make sure that you're doing all that you need to do to take advantage of the current thing and thinking ahead to how to deal with potential changes. And then one last thing, and it didn't make the slide because it's not an exciting tax saving opportunity, but just something I'd like people to think about. So we are expecting increased IRS enforcement. There's been proposals for more funding for the IRS. Also, just as tax practitioners, it feels like a constant stream of increased reporting requirements. The IRS wants to know more about, what's your basis and what are you doing? And so we do expect increased enforcement. And so I would just say, be careful, be diligent with your tax reporting, and understand that for us, for your tax CPAs, it takes time for us to help you manage all of that. So sorry to end on a bad note, but I'm going to pause there and I'm going to hand it over to Blaine, and he's going to touch on a few things that are already existing law, but just topic of really frequent discussions with our clients these days.
Thank you, Anna. Never a dull minute in Washington, it seems. And so, like Anna said, I'm going to touch on a couple of things that are they're within current tax law. One is affecting this year, 2021. The next is something that will kick off in 2022. And so, to swing us back into a positive note, for 2021 and 2022.
Hey, Blaine.
Yeah.
Sorry. I just saw Stacy letting us know we want to do our polling question. So
Okay,
that's
sure.
my
Yeah.
bad for not queuing that up, but can we do that before you jump
Yeah.
into the martini lunches? Okay, so hopefully everybody sees the polling question up. Just which of these potential tax changes are you most concerned about? And we have, this is for your CPE, so we're not testing you on these. You can put whatever you want, but please do pop in and answer here in the next, I don't know, maybe Stacy will leave it for about 30 seconds and then Blaine will continue. I think you can go ahead.
Okay. Okay, so as I was saying, for 2021 and 2022, as part of the Consolidated Appropriations Act, business meals are 100% deductible. So prior to that act, they were 50% deductible, but now for the rest of this year and next year, they're 100%. One small or the caveat is that they have to be provided by a restaurant, which I think covers about 99% of business meals. There is an exclusion for on premises meals, like if a big company had like a cafeteria or an employee run kitchen or something like that. Those are not 100% deductible. And as you can kind of see on the slide, once we get through the TCJA in 2026, those would be non-deductible at all, barring legislation. So that's good. Obviously, it was kind of the impetus for it was to kind of help our restaurant industry folks that were hit pretty hard through COVID the past years or past year. And so kind of incentivizing people to get out there and get to restaurants and feed their employees. And it's a great perk that employers can use for their employees, you know, reimburse employees meals and they get the full benefit for that. So that is good. And so I think we should all take big advantage of that the rest of this year and next. Something that is not as fun is the new rules related to R&D expenses. And so this was not part of any kind of COVID legislation or Biden tax law. This was in place in the TCJA. It's kind of one of those things at the back end to kind of help pay or balance out all the goodies we got at the beginning, such as the lower corporate tax rate, QBI, 100% bonus, things like that. So this is kind of the back end of that. And so, like Anna mentioned, there is legislation to potentially kill this, but as it stands now, once we get into 2022, research and development expenditures will need to be capitalized and amortized over 5 years. So currently today, you can take 100% of R&D expenses and take that expense straight to the bottom line. You do have the option now to capitalize and amortize if you are already maybe in a net loss position and wanted to kind of manage that net loss to future years with potential income. You have that option now, but once the calendar flips, that option is gone and you will be required to capitalize those costs and amortize them. And it's 5 years if that research and development is done domestically. If it's done overseas, you have to amortize it over 15 years. So there is a differentiation between domestic and foreign R&D. You might be thinking, well, what really falls into this category of R&D expenses? So as you can kind of see here, the IRS defines it as costs incurred in a taxpayer's trade or business in an experimental or laboratory sense to discover information that would eliminate uncertainty, including cost to develop or improve a product or cost of attaining a patent. The key word to focus on here is uncertainty. So if you're spending money on a new system or a new product, that you're not exactly sure how it's going to turn out or if it's going to be a viable product or take on in the market, those are expenses that would probably fall into this R&D bucket, and that you would need to capitalize to the balance sheet and amortize over the 5-year period. So that's the key thing to think of, and it's your normal things, you know, your patents, investment in new products or testing new systems, things like that. You're going to see it primarily in software, computer software and hardware industries, pharmaceutical companies, engineering, things like that is where you're going to see R&D credits, or not credits, but expenses have the biggest impact. So we kind of had a good thing with the meals. We're getting to get 100% of those for the next few years, but barring legislation, we're going to lose out on our R&D expenses starting next year, but we'll keep our fingers crossed. So with that, I will turn it back over to Anna, who's going to give us a little bit of a refresher on entity selection and how that can impact your tax situation.
Yes, thanks, Blaine. So, entity
Anna,
selection. Yes.
Anna, we just had a question come in.
Okay.
If you wanted to answer it through the Q&A. So for the business expenses, was the intention of the slide to say that everything in the first column is now 100% deductible through 2022?
Not entirely, and hopefully Blaine won't mind if I hop in here, but so it's specifically restaurant, if you meals in restaurants, and I can go back to this for a little clarity. So it doesn't change this, the entertainment piece stayed non-deductible, but it's the sort of things that, were 50% limited. So it still has to be a business meal, right? This isn't just going to dinner with your family on a Friday night, but business meals that are spent in restaurants are 100% deductible for just this time. And so it's a very targeted thing just to kind of prop up the restaurant industry that has clearly suffered quite a bit during COVID. And then after these 2 years, then we're back, largely on course with where we were, other than, we're scheduled to lose some of the benefits of those, on-site employee meals. So hopefully that clarifies that one. So income tax aspects of entity selection, this is one of those oldies but goodies, I think. It's not really new news, but it comes up all the time. So every time that, people are setting up a new business, they want to know what's the best entity for us. And in a time of sort of changing tax laws, maybe that comes up even more than usual. So, a few years ago, the TCJA passed and the corporate rate dropped from 35 to 21%, and that was very significant. And we got a lot of calls from clients, clients that were in pass-through structures saying, hey, 21%, that's amazing. Should I convert to a C corporation? And most of the time the answer was no, because we have to remember that double tax still applies with the corporate structure, right? You got tax in the corporate entity and then tax again when it comes out. It's also just less flexible in sort of getting cash out and getting other assets out. So most of the time it was no. There's always a math equation to do, right? When you look at the rates, and I know that as accountants and finance people, we want to just plug some numbers into Excel and say, okay, there's my answer, that's it. But truly, it's more complicated than that. The structure that you choose really depends on a lot of factors beyond just the rates. And so we'll hit on just a couple of those. And so, factors that would lean you to the corporate side, if you're not expecting to distribute earnings, if you're going to have everything you make is going to get plowed back into new products and growth and all of that. If you expect that when you sell, it can be a stock sale rather than an asset sale. Also if it's a business that qualifies for that 1202 benefit. So we talked about that a little bit earlier, but early stage corporations, some of them can give investors a huge gain exclusion upon the exit. And so in that case, C Corp structure makes a lot of sense. Also, some investors require it, right? So VC funds often want it, foreign investors often want it. And then in terms of multi-state, and this comment is not about tax burden, but more about complexity. We have found that multi-state corporate filings tend to be less complex than pass-through. So shouldn't be your driver, but just something to keep in mind. And then on the other side, factors that would favor pass-through structure, if you're wanting to distribute most of the earnings, you want to make money and pull that cash out to you every year. If you may end up doing an asset sale down the road. Also, if you will get the full benefit of the pass-through deduction. Those are all reasons where pass-through can work well. Also, if you are self-funding losses. So this is a startup and it's bootstrapped and you're paying for it, you can use those losses to offset other income. There are limits to that. I mentioned it a little bit before. So that's not a total free-for-all, but can be beneficial if it's, if it's your skin in the game. And then sort of the flip side on multi-state, The pass-through multi-state filings are just exceedingly complex. It feels like more so all the time. And so just know that it's not a reason to not be a pass-through, but just be aware that it's quite complex. And there's more beyond corporate versus pass-through, right? There are different types. So kind of the big two that we talk about is, do you want to be an S Corp for tax, or do you want to be a partnership for tax? And partnerships are more flexible. You can have different allocations and different distribution waterfalls, and we tend to see those with our real estate groups and with our private equity backed companies, because they want to do something other than pro rata. And S Corps really require that you be pro rata on your cash and on your allocations. So they're simpler, but they're not as flexible. S Corps allow for W-2 wages for owners, and that's long time been a tool to limit the self-employment tax exposure for the owners, because you kind of can just peg it at your wage amount. S Corp owner wages can help with that pass-through deduction that I mentioned. And so again, it really just depends on your business, your investors, what you're trying to do will sort of drive that decision. And then one other thing to just mention, because Form 1065 is what we file for a tax partnership, but there can be LLCs, that can be a limited partnership. And specifically what we see a lot is when we're dealing with Texas franchise tax, a limited partnership can qualify as passive and escape that tax. So if you have a partnership that's really an investment partnership, or holding land, it's going to have capital gain, interest, things like that, an LP can really help you out in Texas, and you can avoid some tax there. So I brought up a state.
Anna, we had
yes.
one question.
Okay.
Can 1202 apply to an S Corp?
No, it has to be a C Corp.
And the other one that came through was, is R&D tax credit going away?
I don't think so. R&D tax credit has been going along, it's extended or it's not, and it's been going along for years, but I don't have any sense that that's something going away. In fact, I think more likely to potentially be expanded. Over the past 6-7 years, there have been improvements and expansion that let more people benefit from it. So I don't get the sense that we're going to go backwards on that. So okay, so I brought up states. That's my cue to hand off to Jennifer. So she's our state tax specialist, and she's going to talk through some things that we really all need to be aware of.
Thanks, Anna. Now just to spend a few minutes giving an update in the world of state taxes, starting with the changing nexus landscape. So basically, nexus is whether you have enough connection with a state for them to actually tax you. So as our economy has shifted over the years to more of the emergence of the e-commerce, most states have shifted away from a physical presence standard to an economic presence standard. This means largely that states will try to assert nexus on you if you have an economic presence in the state, which can basically mean anything as simple as deriving an economic benefit from the state. It has a much lower standard for taxability. It's basically a lot easier for a state to come in and tax you now if you're doing anything in that state, whereas before you had to be physically present in that state. Wayfair a few years ago, of course, gave states a lot of leg room to run on this, setting factor presence for sales tax purposes, but now a lot of states are also doing that for income tax purposes. So it's had far-reaching impacts. One thing, though, that I want to bring up is a recent development in the Multi-State Tax Commission that could really shake things up for our clients that are using Public Law 86272 protection. So Public Law 86272 is a federal law which basically says that states cannot impose an income tax on an out-of-state company if the only thing they're doing in that state is selling tangible personal property. And that's been a longstanding law that's really given many companies some pretty good protection. However, just in August, this just happened, the MTC basically put out a statement saying that certain activities done online would no longer be protected under Public Law 86272. And they're pretty broad and far-reaching. The examples included placing certain types of internet cookies onto computers or other in-state devices, phones, etc. And if those cookies do anything gather any information that is not ancillary to the solicitation of sales, that would mean that that company could have nexus in the state. Providing any type of post-sale assistance to in-state customers via chat or via having an icon on the website that you click to ask a question, that could make you lose your Public Law 86272 protection, or also transmitting any type of electronic code or instructions for software fixes or upgrades. So for our companies that have been taking this Public Law 86272 protection that have any sort of online interface, we really need to start thinking about this and whether this can shift our protection. This is not law yet. This is just a statement from the Multi-State Tax Commission, but it's expected that a lot of states will take this and make legislative updates based on that. So definitely something to be aware of if you're taking any Public Law 86272 protection in a state and you're selling products online. All right, now moving on to remote work arrangements, which we all know very well at this point. We have obviously seen a huge surge in clients with employees working remotely. Not just working remotely, but largely working out of state sometimes. Many employers, of course, expanded employees' ability to work online, and along with that, employers have also started hiring a lot more remote employees, a lot of times out of state, which we didn't see quite as much about beforehand. The important thing that everyone needs to know about this is that if you have an employee working in another state, even if they're working from home, that generally creates nexus with a state. So even if you don't have any employees in a state, even if you're not selling anything into a state, if you have an employee working from home on your payroll, it's largely going to give you nexus in that state. So it's just important to know this and know the pros and cons of whether you should go into more states. I will say, I would avoid high tax states. So if you are looking at hiring an employee in California or New York and you don't have nexus otherwise with New York, my advice would be to pass on that employee unless they are just unbelievable. Because even if you don't have a huge presence in a state, it could be enough to give you an unwelcome tax bill in those states. One thing on this, when the COVID orders first came out, a lot of states did come out with guidance saying that they would give special exceptions for workers forced to work in a location due to COVID, basically meaning if you were a company not filing already in that state, but you had an employee forced to work in that state due to COVID, they wouldn't say that you had nexus with that state. You wouldn't have a state income tax filing responsibility. That being said, as COVID restrictions kind of come down and ease, many of these exceptions are ending. Every week in the state tax updates, there's another state dropping this. So if you had someone in that circumstance for COVID, it might be ending now and you may no longer have that protection. And then finally, on Nexus, a few notes on revenue sourcing. Every state has their own rules for the sourcing of revenues. The sourcing of items for things like tangible personal property and realty thankfully continue to be rather straightforward in figuring out where we source those to. But the sourcing of services continues to change and evolve, especially, like I said, more and more companies are moving to electronic services. Everything's being distributed via the internet. To catch up with that and make sure that states are still getting their true piece of the pie, more states are moving towards a more market-based sourcing approach, looking at the location at which a customer receives the benefit of the services and no longer where a company provides their services. Okay, so what does all this mean for our business or for your business? Basically, states are becoming super aggressive in finding taxpayers. I know Anna talked about the IRS being more aggressive. States are right there behind them, increasing their collection efforts. And when they find you, it's surprising how much the state tax bill can add up and past due taxes and penalties. And as the rules for states have changed, you have kind of this killer combination of market-based sourcing and economic nexus. And a business that may have never even set foot in a state can suddenly have a pretty sizable liability because they have customers in the state and they're deriving a benefit in the state. And a lot of times this comes up during transaction due diligence. And whenever you're in there and you're picking through the nexus rules and the filings, and you suddenly realize, oh, well, you know, we've been selling into California for 6 years and we never filed there. You can get into some pretty big numbers pretty quickly, and that's not something you want to discover when you're trying to go through due diligence. Then one other important thing on this, we have a lot of companies that are flow-through entities, and of course, whenever you find these issues, there's exposure not just for the entity, the flow-through entity, but also on the business owners. So what do we do to avoid these big state surprises? The first thing, annually, your state tax presence needs to be analyzed. The tax group needs to be looking at this. If you sell services, you need to know where your customers are. You need to be able to have your software integrated somehow to where you know where all the customers are located and receiving the benefits of the services. At MLR, we provide all of our clients with a really good detailed apportionment workbook as part of our PBC work papers. We provide it to you annually, and we ask that you all fill it out every single year. And I know it's a lot, and I know it's a pain, but it really helps us nail down those states where we need to be filing. So we ask you that you please do that. And finally, kind of the final step, if you do realize that you have exposure in a state, then you just kind of weigh the pros and cons of filing there. You have to determine the materiality of the taxes due and weigh that against the compliance costs to get caught up there. So those are some things that you can be doing, you know, right now to look out for those things. But one big issue that we see come up a lot, we've titled it Trap for the Unwary, State Considerations when Selling a Business. This is an issue I definitely want to highlight. As I briefly mentioned before, there can be huge state tax consequences when selling a business. A lot of times the state impact is kind of an afterthought, and I'm not saying that the state tax impact should drive a transaction, but you should be prepared for the state tax impact as part of a transaction. The sale of a business can generate an unexpectedly large state tax bill, and so you just need to be prepared for that. If you have a transaction that's structured as the sale of equity by an individual, then a lot of times in that state, you only have to pay on your state of residence, which is obviously good for our Texas residents because we have no individual income tax. But when we're looking at entities, if we have an entity recognize a large business sale gain, like via a sale of assets or a lower tier entity, most states are going to say, all right, that's great. You've been doing business in my state for 3 years. I'm ready for my piece of that pie. They're going to want that piece of that giant gain apportioned to their state and tax paid on it. And that additional burden, it can add up to, you know, maybe 2 to even up to 5% on top of the federal tax liability. And when you've got a big gain, those can get into big numbers. So like I said, it's just something to be aware of and make sure you plan for it, because it can be really painful to find out on the back end you have all the state tax due and you've already distributed all the money or the cash is out the door. So that is something not to be ignored. All right, and then the next thing I wanted to highlight while I have y'all today.
Hey, Jennifer, I'm going to
Yes.
pop in just real quick.
Sure.
A couple things, and I can chime in that we have all seen that painful experience that Jennifer mentioned. So this is a real thing and something to pay attention to. I'm just watching our time. It's coming up on 9:20. I think we have two pretty key things still: the Texas franchise tax rule changes, and then Blaine's going to talk about employee retention tax credit. I want to make sure we have time for both of those. And so we've been monitoring the Q&A. So it sounds like we're going to run probably right up to 9:30 and not have a whole lot of time for Q&A at the end. But please put your questions in to the Q&A. I'm answering them as I can. If we don't get to them, we'll email you, and please feel free to email us or call us later. So anyway, didn't want to shortchange the Q&A, but I'd like to use our last 10 minutes on those topics. So, okay.
Okay, thanks, Anna. Like Anna mentioned, in January, Texas put forth some really significant amendments to their sourcing rules. Like we've talked about most states are moving towards market-based sourcing just because of the economy that we're in right now. Well, Texas, under their margin tax since 2008, has sourced services based on location where performed. So the amendments that came out in January are really rocking kind of that standard. They moved Texas much closer to a market sourcing state. And what's really interesting about these amendments is most of those changes are retroactive to January 1st, 2008, when the margin tax first came out. So if you have a company affected by this, there's definite refund opportunities to go back as long as those returns are open for refunds. So real quick, I just want to go over a few of those changes that Texas put forth. If you can just move it forward one, Anna. Great. Okay, so these are those general items that were impacted by the amendments. General services. So like I mentioned previously, this was sourced based on the location where performed. The amendments now call on taxpayers to look at, and the language they use is the location of the receipts producing end product act or acts. In reality, what this means in the context of services delivered electronically, you're largely now going to look at the location of the customer, moving to a more market-based sourcing approach. This is a great development for a lot of our Texas technology companies, because previously they may have been providing services into a market-based sourcing state like California, so they had to pay California tax on all of that, but then Texas was still sourcing it to Texas. So they're no longer going to be double taxed. So this is great news. Guidance came out on internet hosting and streaming services. The definition of those was expanded to include things such as entertainment streaming services, data processing, market provider services, and those are now sourced to the location of the customer. Advertising. This was a big change. The sourcing of advertising services is shifting away from where those originally were transmitted and now sourcing them to the location of the advertising audience. So this provides a substantial opportunity for tax savings for advertisers located in Texas, but with a national presence. Computer hardware and digital property, more guidance was given to taxpayers to let you know where you fall in that, and also clarification that delivery of digital property as a service should be sourced based using market-based sourcing. So again, huge for our Texas technology companies. So other clarifications made address capital assets and investment, broadcasting, and transportation services. So if you have revenue from any of these items, there are definitely opportunities for you perhaps to go back and get some refund claims in. So that just about wraps up my quick update on state taxes. But before I hand it back over to Blaine, I wanted to bring up our next polling question, Stacy. Okay, which of the following state tax developments will have the most significant impact on your organization? We love to know what's affecting you guys, what y'all are worried about. So if you don't mind answering that polling question, we would appreciate it.
Thanks, Jennifer. Thanks for that update on the ever-changing landscape of state tax. I honestly do not know what we do without our state and local tax experts, so thank you for all you do. As Anna mentioned, we're kind of running up on our time here, so I'm going to kind of shorten my last little our section on COVID relief items. You can see on the slide here, there's been several different relief items that the government has put out over the past year and a half to try to help us through these times of COVID. We've had the stimulus checks, we've had PPP, we've had the paid leave subsidies, we've had an opportunity to defer payroll taxes, and then as we're going to go into now is the employee retention tax credit. And I'd like to just kind of start by saying this is going to be a very high overview. If you have any specific questions, we really advise you go to your payroll provider because they know the real nuts and bolts of this credit. So there's been basically this credit has evolved through 3 different tax bills, but the qualifications stay the same. Sorry, Anna, back there we go. The qualifications are the same for all 3 iterations. Basically, you had to have either been shut down partially or fully by a government mandate, or you must have seen a significant decline in gross receipts. Now, that definition of a significant decline has changed through these different tax bills, but nonetheless, there has to be a decline in your gross receipts to comparable quarters, either in 2019 or 2020. So, and then also through all three iterations, like I said, this is a payroll tax credit. You will file it on a 941. It will not be on your income tax return, but you will need to keep in mind that your wage deduction will be reduced by any amount of credit you get. So that's just something to keep in mind as well. So those things are the same for this credit through all three iterations. So now we'll kind of get into the differences. The first credit came through, it was born in the CARES Act. It was a 50% credit on the first $10,000 of qualified wages to employees. And it was capped at $5,000 per employee for the entire year, so all of 2020. And it was originally just to be between March 12th, 2020 through the end of 2020. What defined qualified wages was if you had 100 employees or less, all of your wages were qualified, and you were considered a small business. If it was more than 100, then it was only on wages paid to people who weren't actually providing services for you at the time. So meaning you were truly retaining them in a time when they weren't working. There's a small pay raise limitation, which we're not going to go into for the sake of time. But the big thing was you couldn't get the employee retention credit and PPP. It was one or the other. And so most of our clients and most people got more benefit from the PPP. So they didn't really pay much mind to this employee retention credit because it was one or the other. So then we fast forward to December, and we have the Consolidated Appropriations Act, and this expanded and extended the credit. So it extended it through the June of this year, and it expanded it from 50% of the first $10,000 of wages to 70%. And it also changed it from having an annual max to a quarterly max per employee. So as you can see, we went from a 5,000 max for 2020 to a 14,000 max for 2021, and that was basically a 7,000 max per employee in Q1 and Q2. They also changed the language for what defined a significant decline in your gross receipts. So previously it was a 50% decline. Through this bill, it moved to just a 20% decline. So it opened up more, or it made the credit attainable for more businesses that didn't have to have such a sharp decline in gross receipts. It also expanded what businesses that qualified for the small employer from 100 employees to 500. So if you had less than 500 employees, all of your wages counted, whether your people were working for you or they were unable to work for you. They got rid of that pay rate limitation. And the big thing here is they said, retroactively, you can have both. You can get PPP and you can have the employee retention credit. The only catch is you can't use forgiven PPP loan funds to pay those wages. So there's some math there to figure out, okay, this is my PPP loan. I use these for wages. I had these wages in excess of that. Those wages would then qualify for the credit. So that's where we were at the middle of the year. And then we're to our third and final iteration to where we are now. It didn't really expand the credit anymore. That it's still at the 70% of the first $10,000 of wages, but now we've gotten two more quarters. We've gotten Q3 and Q4 of 2021. So that takes us from a $14,000 max per employee to a $28,000 max per employee. They also instituted this new recovery startup business category, which is for basically entities or businesses that started during the pandemic and don't necessarily have comparable sales. They're now, there's a subset of them, or I should say a subset of rules for them within this credit that allowed them to take it. And it maxed them out at 50,000 a quarter. That's not per employee, but in total, they couldn't take more than 50,000 of the credit in total. So I know that was a super crash course. So what we'd like to really point you to do, like I said, is go to your payroll providers. They know this stuff like the back of their hands. And then there's also a lot of specialized tax credit firms that have historically done R&D credits or cost segs. They are now in the space of employee retention credits and can really help you figure out if you can apply, go back and amend old 941s to take benefit of the credit, and or kind of contemporaneous filing of the credits now for these quarters. So look for them. If you need a referral, we'd be happy to refer you. We have lots of contacts in the space, and they usually charge on a kind of a contingency basis a percentage of the credit you get. So it's not like you're going to be out of pocket for something you're not a benefit of. So with that, I will turn it back over to Anna or Sarah to close us out. Thank you so much for your time today, and look forward to the next two sessions. And there's one more poll.